Let's also welcome on board Mark Mathews and talk about what he's making of the markets, both India as well as global right now. Mark, great to have you on the show. Just looking at the Indian or for that matter, global market screen, and I guess the fact that US CPI came in at 8.5%, lower than what the market was anticipating, that sort of instilled further fuel to the rally. One's wondering now what the Fed's next course of action is going to be and whether central bank here in India is going to follow suit or not.
On top of the good CPI number, we also had the PPI last night, just corroborating the fact that inflation has peaked, and a very strong jobs number. So putting those together, I think we can see why the market has rallied so strongly. But to your point about what the Fed's going to do, Fed officials have been communicating in no uncertain terms that they do not plan on cutting rates anytime soon. And yet the futures market is pricing in rate cuts next year. So I think that could be one area, one thing that kind of caps the market here is the idea that rates are not going to be coming down. Even if they're not going to go to the moon, they're not going to be coming down anytime soon either. And then the other thing I would just say is that the earnings season, which is now largely behind us, showed aggregate earnings up about 6% for the S&P. But if you exclude the energy sector, they were negative. So ultimately, what moves share prices is their earnings, and the earnings are still looking pretty lackluster.
So, Mark, are you saying that this is as good as it gets now, and the best part of the gains for this year are over?
I wish I knew. I think that the reason for the rally was those 2 points that I just identified: the good news in the jobs numbers and the inflation. Going forward, I mean, we're up about, I guess, 13% from the June low for the S&P and about 15% for the Nifty. If you look back at previous, for lack of a better way of saying, bear market rallies, they can be much more powerful than that. They can go up easily 30% sometimes. So after a very big bear market. So I'm personally unsure. We have decided to hedge our equity exposure because we want to remain in the market, but we are not convinced that the rally will continue. So kind of an uncertain stance at this point in time.
Mark, you track India as well closely then. Are you trimming your positions anywhere when it comes to India? Or recommend so?
No, we're not. We have an overweight stance there, and I do think that the fact that China remains, in this difficult situation economically with their property market and their regional banks, and then politically the increase in frictions over Taiwan, all of that I think spells very limited foreign participation in the Chinese equity markets going forward, and that would be a benefit to India.
Mark, morning. Wanted to also understand your outlook when it comes to earnings, because I believe the view is that in FY23, the earnings growth is going to come from sectors that are not dependent on commodity prices. What's your sense in terms of the kind of numbers that have come out? And with an ease in commodity prices, do you believe that we can see that stance changing slightly?
Well, first, I have to apologize that I've been on holiday for a month, so I haven't been tracking the markets that closely, including India. So all I can say is that the peak in inflation and corresponding decline in commodity prices would benefit countries that are more sensitive to inflation and commodity, like India. So it should be net a country that people would look at as a beneficiary of those things. But having said that, the dollar index remains very robust, and we think the dollar is going to head higher. And that historically has prevented a lot of foreign money from buying emerging markets when they think the dollar is going higher because they're worried they're going to lose money in the currency. So I'm sorry, I'm kind of rambling, but I see positives and negatives for India. Net, I suppose, still more on the positive side because I do believe that the economic recovery has a lot of room there to go because the last 10 years had so much subpar growth. There's lots of catch up to do in India.
And Mark, given the fact that there were, quite a few problems when it came to COVID lockdowns a few months ago in China, where do you think India stands versus some of the other emerging markets at the current juncture?
Certainly better than China. And once you exclude China and India, then you basically have South Korea and Taiwan, which I don't think should be classified as emerging markets anymore because they are, they're very developed economies with big middle classes. But nevertheless, they are included in the index. They are very much electronics and manufacturing economies. I don't see a lot of interest in them right now with the idea that the global economy is generally quite soft. They tend to be cyclical in line with the global economy. And then you have, Latin America, which is very resource heavy. Brazil, I think, is still a market that people like to have exposure to, basically because it is a commodity-rich economy. So I don't know, once again, sorry, I think I'm rambling, but I think India looks quite good in the emerging market setting. Number one, because China is uninvestable for a very large part of the global investor base now. And number two, because none of the other ones have a domestic economy as robust as India's, I think.
Mark, 1 month of holiday, Aisha, me and Awan are saying, oh my God, how did you manage that?
And where did you go for a whole month?
Well, I take that back. I was 1 week I was working in Thailand, and then 3 weeks I was in Switzerland and Canada, which is my home country.
Still a long time. Even if you take 1 week back, that's 3 weeks, 21 days.
Yeah.
But I'm glad we still got your opinion on the markets, earnings, and of course, what your outlook is on the US Fed. Mark, we'll let you go on that note. Appreciate your time. Thanks much for taking time out and joining in.